All right, let's get started with the first topic for today, and that is debt funds. How should you position yourself based on what is happening not just here in India but globally? And a lot of eyes went towards the United States last evening when the outcome of the latest FOMC meeting was announced. And what is now seeming like it's going to be a possibility is that the tapering of bond purchases by the Federal Reserve could start as early as November. There is also a larger number of officials of the FOMC that are thinking that there could be a rate hike in 2022. In June, most of them, or nearly all of them, had said that there was unlikely to be a rate hike in 2022. They were expecting it to start in 2023. The last time that a taper took place in 2014, it took 10 months. So what the Fed is saying right now is that it could be completed, in fact, by the middle of next year, and that is quite a quick timeline. We're joined by Lakshmi Iyer, the Chief Investment Officer, Debt at Kotak Mutual Fund, to make sense of this. Thank you so much, Lakshmi, for taking the time. Always a pleasure speaking with you. I've kind of laid the context, I hope. How can we read that from the Indian perspective? What does it mean for debt investments here in India?
Yeah, hi. So therefore, there is obviously all eyes were on the FOMC decision, what they had to say, how they are going to actually start doing this unwinding of excesses that they have created in terms of bond purchases. And so there are two sets of news which we need to track as Indian participants as well. One is, yes, they have announced that they would like to taper, but the good news is that it's not going to be a nasty, hasty kind of an uptick in yields, because the glide path is more gradual in nature. So in all probability, as you rightly observed, they might announce the taper in the November policy, and probably in the November purchase onwards, you could see some reduction, or possibly starting December, going into maybe 7-8 months, or maybe worst case up until September. So I think that is why the bond yields, whether it was outside India in the US or for that matter in India, did not really bat too much of an eyelid, because it's only a gradual glide path which was largely discounted bonds.
How do we move forward from here, though? What are the implications of a rate hike in 2022, Lakshmi, in the US? Do we then see an impact across the globe and also for us here in India?
Certainly, there will be impact, because every central banker, as we speak, would be wanting to prepare a roadmap of a withdrawal or normalizing of surplus liquidity in the banking system. India, again, is not an exception. Second is how to actually depart from the accommodative bias, which is, say again, for case in the US, where they have a zero interest rate policy, towards rate normalization and then rate hikes. So it won't be a surprise. We already saw Brazil today hike rates. Of course, Brazil has a different kind of a problem, but certainly this, to our mind, for example, in India, the rate hikes on the repo front probably could be an FY 2023 phenomena. But before that, we could actually see normalization of liquidity, which is already underway, and also a possible reduction in the corridor between the reverse repo and the repo rate, with an increase in the reverse repo, keeping the repo constant. So it is inevitable that as the US departs from its accommodative bias, world central bankers, including India, will also have to plan suit.
Lakshmi, in fact, that was going to be my next question. I was going to bring the focus back to where we stand right here in India, and we're just a short distance away from the next Monetary Policy Committee meeting. And what you mentioned was the corridor, that LAF corridor. I think you had Deputy Governor Patra also talk about that very aspect, and why the RBI had to do, or the Monetary Policy Committee had to do what it decided to do eventually. How does this pan out, and what does it mean? We're at 6.14 on the 10-year, and there is ample liquidity. What happens to yields, if you can take us through what you expect will happen with the yield curve?
Sure. Currently, if you see the bond market yield curve is extremely steep. the steepest in my career, at least in the bond markets. So the reverse repo rate or the operating overnight rate right now is at 3.35, and the 10-year benchmark bond yield is in the band of 6.1 to 6.15. So clearly, this steepness has to give way to some sort of a flattener by the short end of the yield curve, probably inching up a tad faster than the long end of the yield curve, or vice versa. When the yields come down, the long end actually coming down faster than the short end of the yield curve. Now, we expect both of these to happen in tandem. So if one is expecting a reverse repo rate hike, our base case is that there could be a reverse repo rate hike probably in December. October may be more of the variable reverse repo rate enhancement, both on the tenor and the amount. And as you normalize liquidity, the next step, therefore, would be to narrow this corridor. The bond markets, to our mind, have already priced this to a large extent. So therefore, material disruptions may not remain. The next level would be going towards the neutral. So I think in this policy, rates remaining status quo, we expect enhancement in the VRRR, both in the tenor and in terms of size, because that's what they've been guiding the markets towards. We're not really expecting too many fireworks, because the RBI's mandate also is an orderly evolution of the yield curve, which they are fairly committed to doing.
Okay, so with that in mind, and considering that you're expecting a normalization to take place and to start, as I understand it, by towards the end of this year, how does an investor, and this is coming to the crux of the conversation, Lakshmi, what I want you to communicate, which is how does one position themselves if they're talking about investing in the bond market, best place in order to reduce or mitigate interest rate risk, if possible?
Certainly, it is possible because fixed income offers the entire array of solutions suited to every interest rate scenario. We are in a current scenario where there is surplus liquidity for sure. It's not going to go away in a big hurry. And therefore, the carry or the high YTM or yields to maturity of the portfolio assumes a lot of significance. So the way to play out fixed income in a market like this is to focus on high grade portfolio, fairly diversified, and they have a higher portfolio YTM, and that to our mind offers a reasonable cushion, even if there were short-term disruptions on the yield curve or short-term disruptions on the rate front. Now, to give you an example, a liquid strategy in the industry, usually the YTMs on these portfolios are around the reverse repo rate. They are hugging the reverse repo rate at 3.35%. But the moment the duration increases, say to 1.5, 2 years, and these are again high-grade portfolios, the portfolio YTMs jump to anywhere between 5% to 5.2%. Now, this could be, the sweet spot where investors could consider investments. And as a hedge mechanism, if you are worried about how interest rates rise will actually impact your portfolio, having allocations to floating rate funds could be another extension to the current fixed income offerings. So I think blend these into your portfolio depending on what your risk appetite is and your investment tenor is, because there is no one size fits all. But these could be some of the strategies that investors could focus on.
Okay, where do you stand when it comes to roll down funds? And this is my last question to you. How is that as a strategy?
Clearly, roll down funds, as the name suggests, they usually buy into a particular maturity bucket and they just let those maturities gradually run down, therefore reducing the intensity of the interest rate risk. So these are, I would say, reasonably good alternatives to fixed maturity plans, where investors have been incrementally wary of locking in their funds as these are closed-ended strategies. So yes, these are good, I would say, extensions to your current fixed income portfolios. And depending on what durations these strategies have, if it marries in with the duration that you're seeking out for, it's absolutely okay to go with these funds.